Hello, and thank you for joining us for our information session on Understanding Division 296. Well, my name is Brett Griffiths, and joining me today is Mailene Wheeler. We're both directors of our Superannuation Advisory team here at Vincent's. Basically, we're going to be running through the newly legislated Division 296 tax. There's still a couple of things that are to be finalised around it. But given the interest in relation to this tax, we thought it was more beneficial to get some information out there for our clients so you have a better understanding of what's involved. There we go.
Disclaimer.
Just go
and
through
then,
it. Yep.
And then our information.
Yep. So this is where we're up to. There's been a lot of talk previously in the last few years around this Division 296 tax. Ignore all that, start afresh. It's completely different in how it operates and how it works. So the most important thing is that it is now legislated, effective from the 10th of March 2026. While there still are some draft regulations that are yet to be finalised, everything's a go from 1 July 2026, with the first test time 1 July 2027. And we'll talk what those dates, the significance of those dates as we work our way through. And yes, there's still some administrative details that the ATO need to finalise, but they essentially have best part of 12 months to do so. So what is Division 296 tax? Basically, it's a new tax where your balance is above $3 million. Now, it's a per member tax, and it is based on all of your superannuation balances. Now, the way it works is that you pay an additional tax of up to 15% where your balance is over $3 million, but less than $10 million. If your member balance is over $10 million, then there is an additional tax of another 10% that you would pay. Now, it's only in proportion to your member balance over those thresholds. So it doesn't mean that you're actually going to be paying a full 15% tax or a 10% tax. So you may have heard how it's 30% and 40% tax. That isn't the case. As we'll explain a little bit later on, it's all in proportions. So the headlines are much worse than what you may think. Also, the thresholds are indexed according to CPI in $150,000 and $500,000 increments, respectively.
And it's introduced a couple of new terminology, Brett, as you have up on the screen. We've got now it's the large super balance where it's the 3 million, and then it's a very large super balance for 10 million. So you may start hearing those terms thrown about a bit more as we get into Div 296.
Yeah, look, definitely mine. There'll be some other new terminologies that we'll be throwing in along the way as well, and even some new definitions of existing terminology, just to make it nice and simple for everyone. So conceptually, how it works for a member with, say, $9 million inside super, the super fund itself will pay tax on the earnings that it generates on its entire balance, not just for the member, but for the whole fund. So putting that to one side, Div 296 applies only for the attributable earnings between a member's balance of $3 million and $9 million in this example. That additional earnings is taxed at 15% or a portion of 15%, because nothing in super can be simple, and there are calculations and all sorts of fun games that we need to do to work out exactly what that tax rate will be. And likewise, for a member who has, say, $15 million in super, the same calculation up to the $10 million point. However, because they are a very large superannuation member, they pay an extra 10% on the earnings that are attributable to their balance over that $10 million mark. So in this example, that $5 million.
So who is excluded from this new Division 296? Well, as the slide there says, it's very few. So there are some people who are specifically excluded. We've got them there on the screen. So of importance to note, it's, child recipients of a pension, and then individuals who've made a structured settlement contribution to their super fund at any time. So that's important to note, but very limited in who's excluded. So what about members who die? So this is one of the interesting, I guess we could say, Brett,
Yes.
challenges of Division 296. So for those members who have died on or before 30th of June 2027, they're excluded from Division 296 tax for the 2027 financial year and all the future years. But for those members who do die on or after 1 July 2027, then there is potentially Division 296 tax in their year of death. Now, if liable, this tax is payable by the estate, and there are some potential challenges here that will have to be worked out, because what if that estate is paid out to the individual beneficiaries, and then this Division 296 tax assessment is delivered to the executor, to the estate after death? Are they going to have the ability to claw back that tax from the beneficiaries? So some potential challenges coming up in the future. When a member has died on or after July, they're not going to be liable for Division 296 in any subsequent years, but the draft regulations may bring in some earnings from the future years. So as Brett mentioned earlier, those draft regulations are still out there. We haven't received anything final, so we're going to have to keep an eye on what final regulations we get out there. And that important note that we've got down there at the bottom is that a spouse who inherits a super in the form of a pension may become liable for Division 296 tax. So it's really important to remember that Division 296 is based on your total super balance of $3 million. So you may be out of it at the moment, being under $3 million, but if you then get a pension from a spouse that ceases, that could push you over $3 million and put you into the Division 296 tax regime.
And even if that is for one day of a financial year, you're in the system.
Yeah. Bit of a nasty little thing there. Yep.
Yeah.
So how is this tax calculated? Brett went through a few slides ago how it worked conceptually. Let's get into a little bit more detail. So as I mentioned, it's a scaled tax. So where your total superannuation balance is over the $3 million, the earnings that are attributable to you as a member will be taxed at 15% of a proportion. So we look at it that it's a tax rate of 15%. We multiply that by the proportion of your total super balance that is over $3 million. So for example, in the examples before, Brett said 9 million, so it would be 15% times the 6 million. And then we look at the Division 296 earnings. And that's a different concept from tax and assessable earning, which we're going to go through a little bit later. But that Division 296 earnings too, it's not on the whole earnings of the fund, as Brett mentioned earlier. It is based on your proportion of those earnings. Now, for the balance that's over $10 million, it's that 10% on your proportion of your total super balance over the 10 million, again multiplied by your Division 296. So that's why we don't end up with this extra 30 or 40% tax rate that you're hearing in the media. When you look at it like that, it's hopefully a little bit easier to see the tax impact might not be as bad or scary as the media is portraying. So there we've got down below the summary that where you're $3 million or less, it's going to be a nil tax. The 15% tax will apply on the proportion over 3 million, and it'll be 10% tax on the proportion over 10 million.
Yeah. And I suppose that nil tax, that's more about personally.
Personally on the Division 296
Yes.
tax. We've got to be very clear. This is completely separate to your income tax. So the super fund will still pay tax as it's required, has done historically under the normal tax rules. This is an additional tax that will be levied on the individual member. So what is included in your total super balance, or TSB, as you may see the term floating about? For most people, it's just what you have in super. Now, to be very clear, that's just in your superannuation in Australia as well. So it's your superannuation interest, whether they're in an SMSF or you've got an APRA fund, whether they're in pension phase, whether they're in accumulation phase, all of that super is caught up. It also does capture your super interests that don't have a balance. So that's where we're talking about those defined benefits in accumulation, defined benefits in pension, where it's lifetime life expectancy, flexi pensions. as I mentioned before with the death, it does include in super that is inherited and paid as a pension. So super that's paid out as a lump sum death benefits, not included. So from time to time where people become entitled to pensions, there's going to be some extra strategic considerations to go through, which we'll cover later, but we're talking about like reversionary pensions. They revert on death. So from the date that reverts, that's now part of your total super balance.
And the timing of death benefits and how that actually works will become really important too, Mai.
Yes, it will. And that's something that we'll cover very shortly. So when is a member's total super balance tested for Division 296? And, as it says on the slide, that is what is TSB? What does it use to work out proportions over 3 million and 10 million? So when is a member's total super balance tested for Division 296? Well, for the 2027 year, so that's the year ending 30 June 2027, we're only going to be looking at your total super balance at 30 June 2027. So it does give members where they've reached a condition of release the flexibility and the options to potentially bring their balances down below the 10 or the $3 million threshold by 30 June 2027 to avoid this tax. Now, unfortunately, for the members that haven't satisfied a condition of release, so that's most of us under the age of 60, there is not much that you can do in regards to bringing your balances down, but there might be other strategies or investments that you might want to discuss with advisors that could help with managing the tax moving forward. So then what's happening after the 2027 year? Well, your total super balance will then be assessed at 1 July 27 and 30 June. So then moving forward each year, it's whether your balance was over 3 million at 1 July or 30 June. So what this means is that, for example, you could have an unlisted investment in the fund that has been valued at $4 million at 30 June 2027. But come 30 June 2028, it's tanked. It's been written off. The company fell through. Your balance has dropped to 2 million. Sadly, you are still captured in this Division 296 regime because your balance was over 3 million at 1 July. And that's going to happen every year moving forward. We're looking at your 1 July and 30 June balance to see if it's over $3 million, then you're in the Div 296 regime. So it's going to be a bit challenging at times to really manage this, where you're invested in assets that could be quite volatile, thinking things like the crypto, unlisted investments. It's going to be really important to get these valuations correct and have the evidence to back them up. And also really important for members to be mindful of where you have these assets that aren't listed on a stock exchange or you get easy access to a market value. There's going to be closer scrutiny on these valuations. So there's going to be more evidence to provide it, which could translate to additional costs to get these valuations. So the balances are going to be looked at very closely for Division 296 as well as for the non-concessional and contribution caps and other things that we have.
Yeah, well, I think now particularly now that there's actually a tax impost in valuations not being accurate, I think there, as you say, will be a lot more scrutiny on them.
Yeah. So be prepared for additional requests, our SMSF members, this is part of the reason why we'll be asking for additional audit evidence. Brett, I believe this one is over to you.
So what's included in Div 296 earnings? So this is a whole new earnings calculation, if you like. So as we've got there, basically inside the fund's tax return, so what the super fund pays tax on, you've got your net realised capital gains, your dividends, your franking credits, which then come back off, your contributions. Then we have exempt pension income. Now, how that technically works is you get a tax deduction for the income that relates to the pension. So then that comes off. And that's what the super fund pays its tax on. However, with Div 296 earnings, it's a whole new tax calculation. It runs separate and it is per member, which is all very different. So basically, capital gains is included, realised capital gains. However, we've got some special rules around that, which we'll talk about. Dividends, franking credits are still included, but you don't get the benefit of the franking credit rebate or the offset that comes through. Contributions are not included, and your exempt pension income is still included. So you don't get that reduction, if you like. So basically, the Div 296 earnings will be higher than what the super funds tax earnings are. So that's a different concept, and it will mean additional calculations that essentially we will need to do for our SMSF clients, where they are what's called in scope. So in scope means that you have a balance over $3 million. It means you're in the system, basically. Now, capital losses are a little bit different. So with capital losses, they can offset your net capital gains in a year if they're carried forward on your super funds tax return. So if you have $100,000 carrying forward on your super funds tax return of losses, you can offset that against gains in 1 year, and then that's all good. If you realise capital losses in a particular income year, though, they can, for Div 296 purposes, you don't get to carry them forward. They can only be offset against the capital gains in that year. So the big difference there is, from a super fund point of view, you can carry forward losses. From Div 296 purposes, you use it or you lose it. It's that simple.
Mm-hmm. Lots of special things that we have to work through with this new tax. Hey, Brett.
Yeah, look, there will be. And unfortunately, it's basically this regime throws a lot of the administration, if you like, back onto us as the administrators of the fund and to the trustees.
Mm.
So for funds paying pension, as we sort of mentioned there, that the investment income from the assets supporting are still included in the Div 296 tax. So it's an important distinction, because previously, if a fund was 100% in pension phase, then it wouldn't have paid tax. Whereas now the fund won't pay tax, but the member will still be liable for Div 296 tax. So it means that we have to add back the exempt pension income, and deductible expenses will also be included. So we get to claw them back through as well. So one of the interesting introductions about this legislation is that we actually get to make a CGT adjustment for assets as at 30 June 2026. For those of you who may remember, we had some ability back in 2017 to adjust the cost base of assets. This is different. It doesn't affect the actual cost base of the asset. It is only for the earnings calculation of Div 296 tax. So not only do we have special calculations that we need to do per member, we also need to have a secondary set of capital gains tax cost bases for income tax and Div 296 tax.
Yep. And you mentioned there, Brett, that it was, back in 2017 we did this. Back then we got to select which assets we were doing the adjustment. That's not the case this year?
No.
With this tax, yep.
It's an all-in. So every asset needs to be considered. So we were talking before, Maya, about unlisted investments. Let's say that an unlisted investment this year has performed poorly. So for 30 June 2026, it may have a zero balance or a zero valuation. Maybe the company is currently in liquidation, but it hasn't been finalised. If that then is turned around, it has a value going forward that increases, then if you do your CGT adjustment or your cost base adjustment as at 30 June 26, that particular asset now has a zero cost base. So if it increases in value, when you sell it, you're realising a capital gain. So it really is a case of looking at all of the assets in totality and making an informed decision as best we can, as at 30 June 26, should we go all in on doing a cost-based adjustment?
Yeah.
Sometimes it will be a no-brainer. Yes, you would do it. But I was looking at a client just the other day, and it is really undecided whether it's worthwhile doing or not. I think what will happen is that, particularly for unlisted investments, there'll be more of a push to, if they have performed poorly, to settle them effective 30 June 26 to realise that capital loss beforehand. That makes a lot of sense. Otherwise, it's really just going to be every client will be on a case-by-case basis as to if this is worthwhile doing or not.
And you mentioned there every client. The reason that we're going to be looking at every client is it doesn't matter whether you're currently over or you will be over the 3 million at 30 June 2027. This is a one-off chance to opt into this cost-based adjustment because, as you mentioned earlier, your capital gains for tax, you can elect to have this to recognise this growth that we've had up to 30 June 2026. So you're not paying that higher Div 296 tax moving forward. So everybody needs to consider this. Whether it's appropriate for them. Unfortunately, we don't have crystal balls to look at the future.
Yeah, and look, that's a really important point that you make there, Mai, because even right now, even if your balance is, say, $1 million, we're talking about $3 million. That seems like a long way away. But if the member does a downsizer contribution, a CGT rollover relief contribution in, non-concessional contributions, it's possible to get to $3 million reasonably quickly. So, or if a member dies and you're moving super from one member to another member. So if there is a reasonable unrealised capital gains tax position, then it would probably make sense to do it, but it really is going to be a case by case.
And one other thing that's really important for us to note is that to be able to take advantage of this cost-based adjustment, that we need to make sure that our tax return for 2027 is lodged on time, because we have to make the election before the 30 June 2027 tax return is lodged. So that also then has an impact for even 2026 tax, because if you're late lodging that, we know that that brings forward your 2027 tax lodgement deadline to 31 October 2027. So a few moving parts that, even though it seems that it's far away in the future, that we just need to be making sure we're on top of. And then what about the non-SMSFs, Brett?
Yes, obviously, we're more focusing on SMSFs because they're much more fun. But it is important to note that there is differences when it comes to the CGT or the cost base adjustments for non-SMSF funds, so the larger industry funds. They only can do it over a 5-year period. And basically, there's a scale that's involved. So it's very different in how it works. And once again, this is all part of the draft regulation, so it's still to be fleshed out, but it works very differently. So there'll be very different results for an SMSF and a non-SMSF with Div 296 and that cost-based adjustment.
So sharing Division 296 fund earnings amongst members. Now, Brett and I have both touched on this previously, but we wanted to go through it in a bit more detail because we obviously, as Brett mentioned, we love SMSFs. They are more fun in our eyes. So we've been focusing on this. But we know that lots of clients also still have an APRA fund, or some of the clients watching, you might not even have an SMSF. So you may be in an APRA fund. So how will your fund earnings be attributed to you when you're in an SMSF? Well, we're going to be using a weighted average of your member balances. So any specific asset allocation, so what we refer to as segregation in your fund, we completely ignore that for Division 296. And this is going to mean that we're going to need to get a special actuarial certificate. It's not going to be required where there's only one member in the fund, because obviously 100% of the income is for you. But where one member falls within the scope of this total superannuation balance, we're going to need a special actuarial certificate to confirm their proportion of the earnings. Now, for APRA funds, their method will be different. They're going to be looking at a fair and a reasonable attribution. So they're going to take into account things that are listed in the regulations, so their investment options and asset allocations. But the key that they have to follow is that it needs to be consistent and fair to all members. So as we've stressed there, SMSF, we're going to need to calculate the earnings and get another actuarial certificate to make sure that we get that fair allocation across to all the members, and the APRA funds will use a fair and reasonable attribution method.
Yeah, so essentially the APRA funds are using a vibe test and the ATO will be determining what that is, and they haven't worked that out yet.
Yeah. So then we've got the reporting, the payment and the assessment of Division 296 tax. So here's kind of a step-by-step view of it. I like to think of it that it's very similar to how we go through Division 293. So that's that tax that's assessed on the high income earners or over 250,000. And the super fund reports member balances to the ATO. So they get that. They're then going to step through and go, okay, what member has a total super balance of more than $3 million? Because they're going to get all that information from the APRA funds, the different SMSFs. They're then going to reach out to those superannuation funds and request the relevant super earning data from the super funds. Now, we don't have any details yet on how this information will be requested or reported for SMSF, so it could be on the tax return, it could be something separate. As soon as we know, we can communicate that.
I would presume, that the earnings calculation will be a separate request that will come through to the trustees, so probably via the SuperStream notifications tool that exists. I think what will be interesting is the time frame that we have to request the actuarial certificate, obtain or do the calculations, to then work out exactly what the members or the in-scope members' Div 296 earnings actually are.
Yes, especially because one of the challenges might be, what if it's a client that we haven't looked after in the previous year? Who is then going to be providing that information? Because we won't have the nitty-gritty details of it, the data. So it'll be interesting to see how this is reported moving forward. And so, for the in-scope members, then the super funds will calculate the Div 296 earnings and the relevant super earnings. We'll report that to the ATO. And then the ATO is the one that's going to calculate what your actual Division 296 tax liability is. They will then issue an assessment to the member. So that will be addressed to you as an individual taxpayer. It will come through, and very similar to the Division 293, you then have a choice that you can make. You can make an election to pay that personally using your own funds, or you can ask for the super fund to release that and pay that directly to the ATO. Now, it's really important that in that process, that the process is followed correctly, because just paying the money directly to the ATO or releasing it to yourself and reimbursing can accidentally trigger illegal early access of superannuation monies. So there is a process and it will be followed. That part we're pretty confident with, because it will be like Division 293. Yeah. We know how to do that and can help clients, but the reporting side will yet to know the details. Here is a slide that just summarises what I was talking about before, and it's just got the timeframes on it. So you can see you have 60 days from when the assessment is issued by the ATO to make your election. You can do that through MyGov, or you can have your tax agent do that for you. And then you either pay it directly, or the ATO issues that release to the super fund. The super fund usually receives that message through SuperStream. They send you, the trustee or your advisor, the instructions with a specific payment reference, and the money needs to be paid to the ATO within that time frame that they tell them.
And all that happens after the ATO have the information to do the calculation.
Yeah. So we've gone through a lot of information there about what this tax looks like, how it's going to work, really focusing on a reminder, guys, it's a proportion of the earnings. It's not all of it. It's on an individual basis. So I guess the important part is, what does that mean for our clients? What should they be thinking about? So here are some of the strategic call outs that we've got. Look at, should you be withdrawing any money now to avoid Div 296 tax altogether? We have until 30 June 2027, but maybe July 26 might be better to give you a better fund tax management position. Brett mentioned earlier about the cost-based adjustments as well, because some people might be withdrawing to keep under 10 million. So you might be wanting to reset. Again, that withdrawing though, part of a greater conversation? Is this part of succession planning, reviewing your structuring? What is the underlying reasons for wanting to withdraw?
And the reality is, Mai, that if you're withdrawing to then invest it in another entity, unless you're over $10 million, it's probably not worthwhile.
And we've done some initial calcs for some clients, Brett, where we've been looking at that to kind of go, yeah, it's not something that necessarily rush out and take action now. Have the conversation, run the numbers, work out what your actual strategy is and what you're wanting to do in the long term, to see if it's, just taking a step to avoid a tax might not actually avoid tax for you.
Yeah, correct. And it's really the same thing about withdrawing into the future as well. So after 30 June 2027, you need to be mindful of the impact that if you do it in a particular year, as you articulated earlier, it's the opening or closing balance that is taken into account. So after 30 June 2027, it's not just the closing balance you have to worry about, it's also the opening balance.
Which kind of ties into our next call out about the spike in balances at 30 June. It's going to drag you post 30 June 27, it's dragging you into 2 years, not one. So because you're over the 3 million, you're in it for the next year. So high volatile assets will remain a challenge. And part of this tax, I think, is clients really considering their asset mix, but not, you should never invest based on a tax.
Yeah.
It should still be with your consideration to members' risk profiles and diversity and the income and all of those things. But it does, the consideration into these volatile assets and crypto or unlisted, it's something that you need to be considering.
And obviously the timing of significant transactions. So whether it be making non-concessional contributions or downsize a CGT rollover relief contributions, all those things happening at a particular point in time could increase your member balance, so you're now in scope, whereas otherwise you might not have been. So they're just things to think about. Super is still the most tax-effective investment vehicle, so long as you're now under $10 million.
Yes. And again, that ties in perfectly, Brett, to our final slide here about the rules of thumb, that, as you said, super under 3 million, definitely still one of the most tax-effective vehicles, particularly when you're in pension phase. So if you're under 3 million, you probably don't need to do much other than consider about opting into the cost-based adjustment. Yep, 3 to 10 million. So some of super income is taxed at 30% at worst, likely to be the same as outside super. Also, if you're moving money from super to another vehicle, capital gains tax. You've got all these, transaction costs have to be considered as well.
Yeah, particularly if property's involved.
Yeah, that can be a significant cost to move assets out of super. And then super over 10 million. That's what you were saying. Some of it might be taxed at the 40%. Could you get a better rate outside of super? So you might consider transferring some of it out to bring it under that $10 million threshold if you have the ability to do that. I was going to say, these are really important. Again, you have to take money from super, you have to have satisfied a condition of release, which generally requires that you're age 60 and above. So that's something that people might be restricted in even having an option to do.
And I think, it really opens up more so the opportunity to have those estate planning discussions about perhaps giving the next generation or even the one after that some of that super money for them to benefit from, rather than it sit inside the super fund that will then be paying more tax on the earnings. I'm a big advocate for passing money through to the next generations so you can actually appreciate them benefiting from that money rather than you leaving it to your estate to deal with.
Yeah. So, and this tax is another time to consider all of those implications. Thinking too, we mentioned earlier the reversionary pensions, really important now. If you've got a reversionary pension in place, to discuss with your estate lawyer and us about whether that's still appropriate. You don't want to accidentally end up in Division 296. And for pensions being commenced in the future, Division 296 now becomes something you have to consider in whether a reversionary pension is the most appropriate pension for you, or whether you've got binding death benefit nominations and don't need to do reversionary. But every case, as we always say, Brett, is different. So it's a case by case basis, but just being aware of these things so you can make informed decisions.
Yeah, correct.
And we've got down there, Brett, this is the death benefits tax.
Yeah, so a little bit off topic, but I think it's always worthwhile mentioning that when a member dies in super, if it doesn't go to a dependent, so typically their spouse, there's up to a 15% tax on their benefit that comes out of super. So that also gets overlaid with all of this as well. So if you have someone with a very large super balance that happens to be all taxable for some reason, the effective tax rate on death could be quite substantial. So it's all part of tax management, I suppose, and that and more broadly that estate piece. Yeah.
So all of these things to be considered together to determine what's in your best interest and most appropriate for your circumstances. So engaging in that advice and making the informed decisions is really important.
Yep, most definitely.
Yeah. Well, I think that's all we've had. But if you do have any questions regarding Division 296 and how it applies to your situation, our contact details are on that earlier slide. But please reach out to Brett or myself directly, or the Greater Vincent's Private Wealth and Superannuation team.
Thanks for joining us.
Thank you.